My name is Thomas, and this is For the Common, a super important question that I get asked all the time. I'll have friends come up and say, Thomas, is now the right time for me to start investing? And before they finish their question, I just want to jump out of my chair and be like, yes, absolutely, 100% start right now. In truth, it's actually more complicated than that. And there are generally a few questions that I'll try and ask my friends just to make sure that it's the right time for them to kick off their investing journey for the first time. So, in this episode of Beginner's Lounge, I'm going to walk through those considerations and share my points of view to hopefully help you determine whether or not now is the right time to start investing. So the first thing that I always focus on is that you have to set aside a little bit of money up front. So think about that as an emergency fund. And there are some statistics out there that are honestly sad that most folks, if they had to in an emergency, would not be able to come up with $500 to pay an unexpected bill. And if that's you, that's totally okay, but you have to start trying to set aside a little bit of money as much as you can. And I get it, it's a struggle. A lot of folks are there living paycheck to paycheck, but you have to start looking for ways to save. So it's super tough, but some of the examples that have worked for me over time or that I learned to cook kept me from going and eating out a bunch, save a bunch of money that way. We also bought a nice coffee machine, so I don't have to go to Starbucks and pay $5 for a latte every time. We also shop at Costco. Too much, but we do go to Costco or other discount grocers, and we save a lot of money doing that versus going to Whole Foods. And we always are looking at our subscription services like Netflix, Spotify, trying to figure out ones that we can live without and then save money by canceling those subscriptions. And then finally, when I'm trying to figure out if I really need that new pair of shoes, I'll ask, do I really need that new pair of shoes? And if it's the right time to get them, hey, go out and get the shoes. But just having that stop and asking the question helps me save money when I can say, I can get a couple more months out of the ones that I have. So I know using money for these types of things can be really rewarding and important for people. But if you're finding it difficult to meet your current expenses just in your current situation, investing probably isn't the best use of money for you just yet. The second point, which I believe is the most important, is that you have to pay off high interest debt as quickly as possible. And let me emphasize that point, high interest. And that can mean different things for different people, but a good general rule is that if you're paying an interest rate of 7, 8% or higher on any loan or debt, you want to try and pay that down fast. And this concept is critical. This idea of the cost of money, or if you're going to use credit cards or buy now, pay later, or even a car loan, how much does it actually cost you to borrow that money? And that's determined by what's called an interest rate. So any loan that has a 7 or 8% interest rate or higher, in my opinion, should be paid back as fast as you can. So the worst of all and the most obvious, if you have any credit cards that have credit card debt that you've been carrying month to month, you have to pay that down before you start investing. With any excess money, pay that down. And that's because credit cards can carry some of the highest interest rates out there. So that can be between 15%, 30%. It's really, really expensive. And no matter how good you are at investing, a 30% interest rate on a credit card is going to be really hard to overcome, even with the best investment results. So, for example, if you're invested really well and last month you made an awesome 20% return, good for you, that's amazing, worth celebrating. But if you're paying interest on a credit card that's currently 30%, that 20% that you made in the market actually doesn't cover the 30% that you're paying for your credit card interest. So even investing extremely well, you still lost 10% on your investment because you were paying that interest on your credit card. So the moral of the story is that if you have any credit card debt, student loans, car loans, personal loans, a lot of loans out there, whatever, that are charging you more than 8% interest, it's my view that you have to pay that down before you start investing. Importantly, though, and in my opinion, not all debt is bad. And that's why I emphasize paying off high interest debt only. So if you're one of the lucky ones that has a car loan or a mortgage on a house that's a 7% interest rate or below, you may be better off investing that money versus paying off the loan early. So let me explain. The overall stock market over the long term goes up somewhere between 7 or 8% per year. So sometimes that's more, sometimes it's way less, but the average over the long term is around 7 or 8%. So if you have a mortgage that's costing you 4% right now, but you can make 7% over the long term investing in stocks, for every dollar that you decide to invest as opposed to paying down your mortgage, you're going to make that 3% difference with investing versus how much that money actually costs you with your mortgage. So there is always risk when you decide to invest as opposed to paying down debt when you can. But I believe that some debt is good debt, especially when it has a low interest rate. The last thing that I like to ask my friends is whether or not they've set aside some money for an emergency fund or if they have any big expenses coming up. And life can happen. You can have layoffs occur, cars can break down, people can get sick or disabled, and having some money set aside in an emergency fund can be a lifesaver. So it's probably a good idea. And the usual recommendations that I hear are that you want to have somewhere in the ballpark of 3 to 6 months of expenses saved so that you can pay your bills if something catastrophic happens. The other consideration is whether any big expenses are on the horizon. So if you have a big expensive trip coming up, if you need money to pay for your car loan payment, or if you want to put a down payment on a house in the next 3 months, investing that money in the stock market today can be a really bad idea. And the reason why is the stock market can be super volatile. It can head down 10% in a flash. And if losing 10% doesn't allow you to pay the obligation that you have, you'd probably be better off keeping that money safe in a bank account, in a CD, or some other low risk vehicle that hopefully is FDIC insured. And then the only caveat to having an emergency fund or setting aside money for a big expense is whether you have access to it can borrow money cheaply. So if you have a line of credit that allows you to borrow money at an inexpensive rate to cover any emergency, then having less saved in an emergency fund is probably okay. But for most folks, an emergency fund is a good idea. So those are the three considerations. 1, do you have a little bit of money set aside today? 2, do you have any high interest debt that needs to get paid down? And 3, do you have enough money set aside in case of an emergency or for any big upcoming expense? And if you feel comfortable with those considerations, then congratulations. You're likely in a really great spot to kick off investing and participate in one of the greatest of just wealth creation engines that exists out there today. But you have to remember, investing is a long-term game, 3 to 5 years at least, and it's impossible to time the market. So you have to have a good investment strategy and you have to be ready to weather the ups, which are awesome and great, but also the downs, which can last for years. And that will give you the best chance for investment success on your way to financial independence. And if you're not quite there yet with respect to debt or with your emergency fund, don't stress. You're not alone at all. The stock market's still going to be here for you when you're ready to kick off that investment journey. So keep working at it and remember that every step that you can take to set aside a little bit more money or to pay down debt just a little bit more each month or to put a few more dollars into that emergency fund, it's going to get you closer to being ready to invest. And as a little encouragement, there's an old saying about investing that goes, the time in the market is more important than timing the market. So keep at it and get to that investment starting line as soon as you can. And I look forward to investing alongside with you. As always, I appreciate you checking out this video and channel. I hope it was helpful. Stay tuned for more insights on how I'm investing my personal portfolio with my portfolio reveals, or just to learn more from beginner questions just like this one. Thanks again.